Hello. Today I'm going to talk about the statement of cash flows, what it does, how it works, how it relates to the other financial statements. So here I've taken from Planet Fitness's first quarter 2024 financial statements filed with the SEC, and we've got their statement of cash flow here. So statement of cash flow has three sections. The first is operating activities, the second is investing, and the third and final is financing. And then at the bottom, it walks to what your cash balance was at the beginning of the period, what that total change is, and what is your ending cash, which agrees to the balance sheet. So that's kind of the lay of the land of the statement of cash flows. Now, to briefly go through each section, the operating section starts typically with net income. And I say typically because there are kind of two ways to do the operating section, the indirect and the direct. Um, in practice, pretty much everyone uses the indirect. So that's what I'll focus on here. That's how Planet Fitness has done it. And in the indirect method, we start with net income. That is obviously, very operational in nature. We sell our products or services or memberships, and we have a lot of operational expenses, and that yields us a net income number. So that's where we start with, but then we make a few adjustments. So a lot of these adjustments here, we can see our net incomes are starting point 34,973. Now that needs to tie to my statement of operations or my P&L. And if I zoom in a little bit, and I don't know why that's acting like it's not there. Let's get a little glitchy on me. There we go. So net income 34973. So again, these are all interrelated. That's where we start. And then we add back depreciation and amortization. Why? Because there's no cash impact to depreciation and amortization. So, but it did reduce my net income. So my cash balance from my operations is actually better than my net income. So that's why I'm adding depreciation and amortization back. And a lot of these other items work the same. So just to pick one other one quickly, equity-based compensation expense. Again, that negatively impacted my net income on my P&L, but it's equity-based compensation. There's no actual cash. I didn't pay somebody a wage. So I have no cash out, and so I'm adding that number back to my net income. Now then there's this other section here, changes in operating assets and liabilities net of acquisitions. So we can just take a quick look at accounts receivable, and it's saying that actually my change in my accounts receivable also accounted for an additional 18 million in cash. And I've got some notes out here. But what that means is that AR must have went down. My AR balance went down. When I look at March, I should see a smaller number than December in my accounts receivable. And that basically is telling me that I collected more cash than what my sales were in this time frame. And so that's why my net income number is just based on my sales. But if I collected more cash because my accounts receivable balance went down, I need to add that back to accurately reflect how much cash I collected in the bank account. So again, if I go to my balance sheet, here is my, it's going to be all glitchy on me again, accounts receivable as of March, 24 million. As of December, 42 million. So if we do the quick math, 23, 42, 18 million additional cash. Now it's slightly off by, call it $30,000. And again, that's net of acquisitions. So If there were no acquisitions, that would tie. Exactly. So that's what all of these items, the changes in operating assets and liabilities, are doing. And then that ultimately gets us to our net cash provided by operating activities, which for Planet Fitness was great. It was plus $90 million. Now we've got these investing sections, and that mostly relates to more long term assets, um, like our property, plant, equipment, and our marketable securities. So you can see that Planet Fitness bought $26 million worth of equipment in the first quarter, and they also net between the purchases and the maturities purchased, call it 12 million in marketable securities. So of that 90 million, they used almost 40 million to buy more equipment and to engage in some long-term, maybe not long-term, but to engage in some securities purchases. And the last section here is financing activities. So if we issued some stock, as Planet Fitness did, then that would be cash in the financing section. And if we repaid debt, or if we repurchased stock from our investors, then that would be cash out. And I would just note here that the debt in the financing section is the principal only, because the interest is included in the operating section, as that interest hits the P&L as interest expense. And then finally, we just get down to, hey, this is my total change. This is what my cash was at the beginning of the period. This is what my cash is now at the end of the period. 347,897, and that needs to tie to the balance sheet. And Planet Fitness breaks out its cash between its unrestricted cash and its restricted cash, which, maybe they have some revolver or some type of financial instrument that the bank will require them to keep, a certain amount of money in deposits. So by adding those two numbers up here, which I've done manually, 347,897, and that's what we need to see here as my ending cash on the statement of cash flows. So there's a quick spin through the statement of cash flows, what it does, what it tells you, and how it relates to the balance sheet and the P&L.